Hello, everybody. Welcome to the Chamber Music Mindset. I am your host, Anna Rathbun. Today, we have a few things to talk about. I'm going to give you the market update, and then I'm going to talk about two topics. The first is the Fed rate cut from last week. I want to go into it a little bit. And then the second thing is some details on the trade deal that we got with China. Um, I want to give you my interpretation of what I think happened and what we can expect going into 2026. So, with that, before I get started, I need to remind you that nothing you hear on this video is investment advice or solicitation. It's purely for information purposes only, simply because I like communicating these things with the public. It is really for edification. It is so that you can empower yourself to make decisions so that you have the information that you might need or want. Okay, market update. We actually ended the week in a mixed way, but the large cap stocks actually went up. Large cap stocks, as represented by the S&P 500 index, gained for the week 0.72%. So it was positive, but not everything was positive. So we had the mid cap index, Russell mid cap index. Those are medium sized companies losing 0.85%. So negative 0.85%. I'm sorry, that is not true. That was the value. Russell mid cap actually lost more, negative 1.5%. Russell 2000, which is, I've talked about this a lot, that's a small company, small capitalization stocks, lost negative 1.35%. What I meant on the negative 0.85% was the value style stocks represented by Russell 1000 value. These are the cheaper stocks. So the simple way to think about them is these are the stocks that are not so expensive at this time. They're cheaper stocks. They're price to book value. So it's a little similar to price to earnings. The valuation's lower. It happens to contain sectors that are a little bit more old economy, right? Things that would have existed before AI, right? So you have things like banks, a lot of industrial companies, whereas Russell 1000 growth style are stocks with high valuations or that are expensive. They actually gained 1.85%. So it did a lot better. This has been the pattern for many, many, many years. Growth oriented stocks, the expensive stocks have gotten more and more and more expensive, whereas the value oriented stocks or cheaper stocks have pretty much stayed relatively cheaper. And there are many different reasons for this. People think, I won't go into that today, maybe some other time, but certainly this pattern is not something that we're not unfamiliar with. This is a pattern that we've seen for a very long time. And it continued last week. So let's talk about in terms of size of the stocks and size of the companies. I've before said that small cap stocks or small companies, investors deem them to be a little bit more volatile or less stable simply because they're small. There's less room in the balance sheet and less room in the P&L to really have a cushion if something were to go wrong, or if there's increased risk or macro risk or policy risk. We see many of those things. We have seen them this year, right? So what happened? Why were the smaller stocks down? Well, a lot of that had to do with the Federal Reserve, and that's why I wanted to focus on the Fed rate cut last week a little bit later. So the Fed cut rates by 25 basis points or 0.25%. You would think that's good news because for a lot of these small companies, um, they're very interest rate sensitive. So if Fed cuts rates, borrowing costs go lower, yay, it would be a good thing. But there was a sell-off because of what Federal Chairman Powell said, that the December cut, forget the October cut, we already did it, but the December cut is not a given. And that basically sent the markets reeling. Okay. Now, on the growth stocks, the ones that outperformed and gave 1.85% wasn't all the growth stocks, right? A lot of it was led by tech. And this is also a story that we're all familiar with. This isn't something that just happened last week. This has been a trend for the last several years, frankly, since the pandemic began and tech really started to run. And coupled with that, AI, right? AI development, as well as the fact that a lot of these firms traditionally have not been, especially the Max Sevens, have not been dependent on the interest rates because they just had so much cash. Now that cash has been going into building data centers and really moving that AI project along. And now they're starting to tap into the debt markets. But frankly, their balance sheet health is so good that a lot of investors think that it's fine for them to borrow money in order to fund these AI projects into the future. Okay, so that's a very, very short market update. So let's go into the two topics. Um, Fed cut. I already told you there was a 25 basis point cut. Everybody sort of expected that to come. So it was priced into the market. But a December cut was also priced into the market. What do I mean by that? Stocks had gone up in anticipation of not only the October cut, but also, hey, we're going to get another cut in December, probably, right? It was a likelihood that we would get another cut. So the stocks had gone up in anticipation of those, expectations. We got the October cut already priced in, but Mr. Powell threw cold water on the markets and said, don't necessarily expect a December cut. To quote him, I'm going to quote him because he said on the podium in the committee's discussion, that committee is the Fed committee, voting committee, at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at our December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. Now, this meant that, well, if the markets had anticipated that it was almost a sure thing, then it needed to price in a lower likelihood of getting the December cut. So the markets went down. And it hit smaller companies more because, again, smaller companies depend on those rate cuts more than larger companies. Now, what do I think of what uh, Chairman Powell said? Well, yeah, of course, policy isn't on a preset course. The Fed has told us for years and years that it is data dependent. Who knows what kind of data we'll get between now and December? A lot of that data is embargoed, and we may not even get it because the government has been shut down. By the way, it is still shut down as of November 4th, it's Tuesday morning that I'm recording this. Okay. So we'll probably get a September employment number, probably when the government reopens. But frankly, throughout October, the government has been shut down. We haven't had people working to collect information on a lot of these things. So we may not get a labor market report. We're supposed to get that this Friday, who knows? And we may not get an accurate inflation number for October. So this is going to be very interesting. And the Fed chairman actually did talk about some of the blind spots that the Fed has to make a confident decision. And it's probably why it's difficult for them to have confidence in making a decision one way or another. Okay. So I didn't think that the Fed, what Chairman Powell said, was necessarily hawkish. But the markets didn't take it that way, right? Markets tend to be skittish. Now, one thing that the Fed chairman said that the markets paid attention to, and a lot of Fed watchers paid attention to, was just exactly how divided the Fed is. Normally, for years, the Fed has come out whenever it comes out with interest rate policy, whether to maintain or raise or cut, it actually gave us a unified front. And that gives the markets and all of us a lot of confidence that, yes, we're in agreement. We should be doing this. I'm sure there are discussions that happen. And that's why people read the Fed minutes to glean, any kind of dissent that may have happened. But normally they sort of come to a consensus. But here it was very, very heated. And it's frankly the second month in a row. In September, there were dissents. And in October, clearly it was very divided. What does this mean for us? Well, number one, it's a very difficult economy to understand. Okay, are we worried about inflation? are we worried about employment? Those are the two mandates that the Fed has: price stability and full employment. Okay, labor market has been showing some weakness. Do you remember a few years ago when companies were hoarding labor because they were so afraid of not being able to find it because the labor market was so hot? We're no longer in that situation. Firms are afraid to hire, but also they're afraid to fire. But we have started to hear that employers are letting go of employees. So we heard last week Target planning an 18,000 employee layoffs. Amazon, I think they were talking about maybe 20,000. I'm not sure. Don't hold me to that number. UPS is looking at 34,000 cuts. I mean, these are large numbers. It's a really big impact, especially for those who are losing their jobs. So we're starting to hear about an accelerated pace of layoffs from large corporations. So there is this softening labor market, but everyone's afraid of inflation, right? So it is a very difficult economy to really ascertain what is going on. And I talked about the real dilemma between the two mandates. Um, and the path of interest rates is not as predictable as the markets used to think, because we used to get these unified fronts from the Fed. The markets can say, okay, these are the data points that we're getting. We're going to make a bet, so to speak, on where we think the rates will be in December, in January, in March, etc. Well, if the Fed internally is divided, maybe it's not that easy to place those bets or calculate the probability of the rates trajectory. So this just goes to show you just how difficult, more difficult it has become to really understand what the rate trajectory will be. What is my position? I do think that we're going to get a cut in December. There are people who want to cut. There are people who are really torn. And then there are just a handful that actually think there should be a cut. I've talked about the new Fed voting member, Stephen Mirren, as well as Michelle Bauman. And those two are in the dovish camp. The rest of them, I think, are kind of up in the air, right? Some are still worried about inflation. A lot of them are worried about the labor market. We shall see. But I still think we're going to get a December cut. What do I think? Do I think they should keep cutting? Yes, I do, because I do think that the rates are on the restrictive side. There's no reason why we shouldn't be on the normalization, on the normal, neutral Fed funds rate. And the reason why I think that is because I do think that inflation is going to bobble its head around 2.5 to 3%, and that the Fed rate target or inflation target of 2% is probably too low. That is my opinion. Everyone has different opinions on this. Now, what's difficult, again, as I said before, it's a very, very difficult situation right now, is that the front end of the curve, okay, the Fed funds rate, which is the overnight lending rate. I mean, talk about a short term lending term, right? That is the only thing that the Fed controls, okay? The US Treasury yield curve has different time frames. So you can lend on 1 month, 3 month, 5 months, 10 year, excuse me, 5 year, 7 year, 10 year, 20 year, 30 year. It can go up pretty far. So the easiest way to think about this is, excuse me, your mortgage versus your car loans, right? Car loans tend to be about 5 years, so you can borrow for 5 years, but the mortgage tends to be anywhere from 15 to 30 years. So you borrow for a much longer time period. And so can the United States, right? You can borrow, the United States can borrow at 5 years or 10 years, 20 years, 30 years, right? So that's actually the Treasury yield curve, where it tells you the rates at which the United States can borrow. So that those are the benchmark rates. Now, the longer term rates are moving differently from how the Fed is setting the overnight rate. So the Fed funds rate. What do I mean by that? When the Fed, when the Fed, not FUD, when the Fed cut rates by 25 basis points or quarter of a percentage last week, since then, until today, I just checked this, the rates have done nothing on the longer term but go up. the Fed cuts rates and the 5-year and the 10-year go up. What does this mean? 5-year goes up, 7-year goes up, your car loan rate goes up. 10-year goes up, your mortgage rates go up. That is what happens. So even though the Fed is cutting rates to maybe help with employment, et cetera, they think the labor market is soft, too soft for their liking. Does that make a difference when you're trying to buy a car? Does that make a difference when you're trying to buy a home? No, it doesn't. In fact, it went the other way. Now, I will say, earlier I said that these rates are based on what the United States can borrow in, right? So let's check the credit of the United States. For some reason, the market is saying, hey, United States, you want to borrow for 10 years? I'm going to have to charge you more. Your interest rates are going to be high. That's what the markets are saying. And that has everything to do with our debt, our national debt, and our deficit. I won't go into those mechanics today, but this is just the takeaway for today is this: just because the Fed cuts rates on the shorter end, it doesn't mean that your mortgage rates are going to go down. It doesn't mean that the interest rates for your car loans are going to go down. That has more to do with what happens in DC. Okay, so this is sort of real life application for the Fed action from last week. I do think that the Fed needs to cut rates toward normalization because hopefully the longer end will respond to that in due time, maybe not immediately, but it's very, very complex. A lot of things actually influence that longer end of the curve, including, do we feel great about, the United States? Do we feel great about the equity markets? Maybe we need to be in safer haven assets and therefore US Treasury gets a boost, which means yields go down. Again, mechanics not for today. Suffice to say that a lot of things impact the longer end. Just because the Fed cuts rates doesn't mean that your life in financing terms is going to necessarily get better. As promised, let's talk about China. So Mr. Trump and Mr. Xi met last Thursday in South Korea to talk about a deal. Okay. This was highly anticipated. If you remember, for several videos, I talked about whether or not this meeting was going to happen. I don't know if you remember from earlier in October, Mr. Trump got very frustrated with China and said that, that this talk isn't going to happen. There's no reason to talk to Mr. Xi, and placed 100% tariffs on China or goods coming from China. So for a while, it was touch and go, but the meeting did take place. And what came out of it wasn't a deal. I think that I want to make that very clear. It wasn't a deal. It was another form of kicking the can down the road, but for 1 year. They called it a 1-year truce between the US and China trade. Okay, I think that term is very misleading. So, first of all, it might not last a year. We might see, tit for tat, or, I don't know, two countries posturing next month. Who knows? This has sort of been the pattern, right? So, because this wasn't a deal, the 1-year time period I would take with a grain of salt. Okay, the truce part of it also is misleading because truce implies that everyone's just gonna, keep quiet and that we're just gonna negotiate, right? We're gonna talk in good faith. But I'm not entirely sure if that is what's going to happen in the next year, if it lasts a year. What are the terms here? The US removes the 100% additional tariff that it put on early in October, and take the existing tariffs down to 47%. Somebody can tell me how they come up with these random numbers. Why 47, not 45 or 40? I don't know. But 47%. And we're also removing the software restrictions. That sounds like we're giving them a huge, leeway, but the software restrictions actually came the week before. So we actually placed the software restrictions on in order to just take it off. Okay, we gave ourselves ammunition and then, put it away. So is that meaningful? I don't know. You decide. China removes the additional restrictions they put on rare earth mineral exports. Remember, these additional restrictions were what made President Trump angry at the whole process, because in good faith, we were trying to negotiate and they suddenly put a really restrictive, controls on the exports. So they removed that, but not forever, just a delay. Okay, it's just a delay while we're talking, supposedly. China also agreed to remove these antitrust investigation of American tech firms. This also came just in the last 2 months or so. There was an investigation into NVIDIA for potential antitrust violations. There was an investigation on Qualcomm for the same potential allegations. So they're apparently moving that. Okay, so do I think that they put them on in order to give themselves more ammunition? Absolutely. Absolutely. And China also agreed to buy millions of metric tons of US soybeans. Okay, so that's where we are. Now, why do I say this is misleading? This wasn't really a truce or a deal. This is just de escalation from the escalation of the 2 months. So it takes us back to where we were about 2 to 3 months ago. So is that really a truce? I'm not sure. I mentioned that it might not last a year. Um, to be fair, the time frame gives some room for the two nations to continue to negotiate. And, these negotiations are not going to be easy. To think that this was going to happen, what was the first deadline? A week from Liberation Day, and then July 9th. That was like 3 months to negotiate two largest economies and the very intertwined relationship that we have economically. It wasn't going to happen in 3 months. And then it was extended to August 1st. Of course, it wasn't going to happen by August 1st. And then it was November 9th. None of this was going to happen. This is a very, very complex negotiation. And so we bought ourselves some time. So to be fair, okay, that was probably a wise thing to do. And we can continue to talk. But parallel to that, my thought is that something else is going to happen. The two nations are going to continue to race in this AI race, because let's face it, part of this is about trade. Okay, Mr. Trump talks about fairness in trade, etc. Yes, China is dumping a lot of cheap goods in the marketplace. Europe actually just came out last week and talked about potentially having Chinese tech firms when they're selling, or Chinese firms when they're selling goods for cheap price to Europe, that they're going to have tariffs in kind. So in kind tariffs, not in terms of euros, in terms of currency, but in terms of products. I don't get into that today, but certainly Europe is also worried about cheaper goods flooding the markets from China, and a lot of exporting countries from Europe basically losing out to China in the global marketplace. So US isn't the only one. So certainly there is that component to the trade deal, but a lot of it, let's face it, is about technology. It's about trademarking those things. It's about patents, and it's about AI. Okay, so Blackwell chips from NVIDIA, the AI chips, China wants them. Chinese rare earth minerals, US wants them. We've talked about this before. There's a lot more to this. There's national security involved. There is the AI race. I fully expect this race to continue in parallel with the negotiation. This is why I don't think this is going to be smooth. Okay, why do I think that? Right after the meeting was over last Thursday, President Trump came back to DC. But President Xi stayed at the Asian summit. And what happened was, first of all, President Xi warned of breaking the semiconductor supply chain. Okay. Well, if you threaten the rest of the world with, putting severe export controls on rare earth minerals that the rest of the world needs, I would say that's disrupting the supply chain. But nevertheless, President Xi said it. And I don't know if he was saying that as let's all cooperate together kind of message, or I don't know what was behind that, but he said that seemed to be positive. But then he said to a lot of the leaders from Asia, Let's create something called the World Artificial Intelligence Cooperation Organization, which would be an international governing body for AI. And he wanted that to be headquartered in Shanghai. Okay, that's a power move. US doesn't want an international governing body because, frankly, compared to China, we're not really into that much regulation, right? Because sometimes it can get in the way of innovation. But China wants to establish it in Shanghai. That is a power move to have it headquartered there, right? And then what else happened was that Mr. Bessent, Secretary Bessent, came out and said, after this amazing talk, apparently amazing talk, that we still need to be wary of China and that we need to de-risk. We're not decoupling, but we need to de-risk from China. And following that, President Trump said that no Blackwell chips will be allowed in China, nor really for frankly, for anyone else other than the US. That is what Mr. Trump said. That is not necessarily in the negotiating spirit because President Trump knows full well that that is what China would like to have, right? To have access. Even though China said, no, we don't need your chips, we're going to be creating our own. It turns out that China was creating sort of a Frankenstein AI chip made up of components from other companies, right? So they're not actually designing their own chips or creating them. But, uh, you know, Mr. Trump is saying, no, we're not. So we're still posturing. We're still, creating this sense of leverage of both parties. So I think it's going to be still sort of the same thing for the next year. I don't think this is a truce. It's more of the same. But I think the AI war, or I shouldn't use the word war, AI race is just going to get hotter because the advancements in AI are being made very, very quickly. I mean, this is faster than anybody could have imagined. If you utilize AI in any capacity in your personal life or in your company, you know that this every day there's something else coming out. Every day there's some other deals that are being made among the Max 7 companies, OpenAI, and now it's expanding into rare earth minerals or mineral mining companies, as well as liquid cooling technology for data centers. It's really making its way outside of the core tech companies, right? So things are moving very, very quickly. So in the next year, there's a lot to keep up with, especially with regards to United States and China. Okay, that was a lot, but that's what I had to say about the truce. Okay, it's not like it's going to go sleepy for the next year. All right, that's it for this week's video. The government is still shut down, so we don't have government data. Maybe it'll reopen this week, and maybe we may have employment data coming out on Friday. Who knows? But stay tuned. I'll be back next week for another update. Have a great week.